Will interest rates hit 8%? Well, that answer got a little bit closer when rates hit 7.625 on Wednesday, the highest interest rate I've seen in my 22-year mortgage career. Of course, it's affecting my buyer conversations every day as we're watching those interest rates tick up, affecting affordability and qualification, keeping a lot of buyers on the sidelines. Now, I can go all into why, if you can afford it, you should be buying right now as opportunities are open. That's not what this video is about. What I want to talk about in this video is what's happening in the economy that's pushing interest rates to jump that high, that fast. What happened this week that you can go, that's why I'm afraid I don't believe they're going to come right back down again. So let's talk a little bit about what happened in the economy this week and what we might be able to start to watch as a trend. So the 30-year fixed we just talked about hit 7.625. It tracks along with the 10-year Treasury yield. So the 10-year Treasury is the benchmark rate that a lot of other investments are tied to. It's the long-term rate versus, say, a 2-year Treasury, which is short-term and tied to the Fed rate. So that 10-year Treasury is telling me it's an economic benchmark. Where is the economy? And right now, the economy is stronger than we all want to believe. That's at least what the economic reports keep coming out saying. So a lot of the market has been leaning towards the fact that the Federal Reserve will start dropping the Fed rate even in 2023, but if not, in the beginning of 2024. As we're all getting our arms around the fact that the Federal Reserve is ride or die, they are all in on a 2% inflation target. They are not going to give up easily. They're not going to drop the Fed rate. And the market is realizing that this is, in fact, truth. And with that realization is coming their expectations that rates, in fact, will stay higher for longer. So we got an economic report that seems absolutely insignificant. And to you as a consumer, you'd be like, I don't even understand why that's important. And I'm with you. So the durable goods just simply measures the demand for those things that you would use 3 years or longer. Think of a washer or dryer. So the durable goods actually came up higher when we all expected it to be softer, meaning there wasn't as much of a demand for durable goods. Now, there's some underlying reasons why that report is a little bit higher than expected, but ultimately, it simply showed that the economy is continuing to stay resilient, trying to chug along as strong as possible, even though with high inflation and high cost of everything, you would think that we would have slowed down by now. On the job side of things, so we have the economy, and report after report keeps coming out showing its resiliency. The job market is also showing its resiliency. A simple 2,000 initial jobless claims increase, meaning companies are laying employees off. So 2,000 more employees were laid off and entered into unemployment. But overall, the 4-week moving average dropped below pre-pandemic levels. That continues to speak to the health of the labor market. So we have a resilient economy and we have a healthy, strong labor market. The two things that the Federal Reserve Board has been focused on saying, when the labor market breaks, when the economy slows, then we will know we're on track towards our 2% inflation rate. Well, all economic reports are showing that that's just simply not the case yet. Then this week, Federal Reserve Board member Kashkari came out saying that he wants to see the Federal Reserve Board raise their Fed rate twice more. Doesn't mean that they will. It's just simply one board member's opinion. But the fact that he said it this week, after we showed a strong labor market and a resilient economy, after last week's Federal Reserve Board meeting, showing that the majority of them expected the Fed rates to go up, simply spooked the market. Now the market has its arms around the fact that, oh no, the Federal Reserve was right when they said they were sticking to their guns on higher for longer. This was a hill they are willing to die on. And now the market realizes there's truth in that statement. They wanted to see Fed rates come down. They wanted to see inflation come down. And we all wanted to see the 30-year fixed mortgage rate come down. But the road is not done. We are not there yet. And inflation is still sticky and high with a resilient economy and a strong labor market. We're seeing indications that it's slowing down, and we're seeing indications of a soft recession. But again, the rates could still go higher and get worse before they get better. Ultimately, when we look towards the real estate market to determine if now is the right time to buy or to sell, the decision should not be on the rate itself, but on the monthly payment and if it's right for you.